Things were really tough in the first few weeks, but we've gotten better. Matt and Katrina, the large cap team and the global team, have been incredibly useful and helpful for us, looking at stocks from the ground up in WAM Capital and WAM Microcap. So I think we'll look on this period very favourably from a wider team. The beautiful part of the sell-off in March was valuations got to levels in companies that we haven't been able to buy because they don't fit our investment process. A number of companies such as, say, like Appen, a Xero, we were actually able to add to the portfolio over this period. But I think the big structural change that we see, and we've seen it through very strong results, is around those companies offering services to the cloud computing industry. When things first started, there's still buyers around when stocks are down initially 10 to 15%. But when that liquidity dries up and things get really weak, which we saw in March, these stocks just fall and there's just no buying. So we acted pretty quickly for some of the less liquid companies in our portfolio and sold them early on because a number of these stocks fell 50 to 70%.
Could you give me a consolidated view for shareholders just around how you're positioned at the moment, characteristics of the portfolio, some of the sectors where you've got the larger positions, just so people have in their mind how you've got the portfolio set?
So our cash was sitting around 40% in March. We're now at around 24 to 25%, given the day in WAM Capital. Now, I think it's worthwhile understanding that in terms of the stocks we are invested in have materially increased in terms of their size. So if we had a look at our top 20 holdings across WAM Capital, the average market capitalisation has increased by 40%. Over half of our businesses that we're invested in our top 20 are net cash, which means they don't effectively have cash on the balance sheet, which is more than the debt that they have on the balance sheet. But most importantly, our liquidity has increased, and that's the key. So today, we could sell 80% of our portfolio in 10 days. If we go back to February, it was 65%. So we have increased the size of the companies that we're in. So if things worsen, if we see a second wave, we have a greater ability to go to cash. In terms of the sectors that we like at the moment, it's I would say, definitely the agricultural sector we quite like. We think there's also opportunities in the automotive sector. So we own shares in Bapcor, we own shares in AMA, Viva Energy, and that's just based off the view that we think that as we come out of lockdown, there'll be more driving. There'll be more driving to work, less public transport usage, and then potential for domestic tourism in terms of holidays and so forth. More people will drive. And we think those industries can actually revert back to pre-COVID-19 levels pretty quickly. And then the other plays on domestic tourism as well. So we own shares in Webjet, we own shares in Sealink, Ingenia. These are companies that are well placed to benefit from and attractive valuations too, given they've been hit very hard. Very well placed for a surge in domestic tourism. So I'd say that's sort of around the edges, but I'd say it's largely on a stock-by-stock basis that we look at things. But if we had to pick a few sectors where we'd probably have a bit greater weighting into, that'd be those three sectors.
And over the next, short to medium term, are you bullish, bearish, or neutral?
I'm probably bullish in the short term. I think social distancing has worked, which is the first tick. We've shown that in Australia. There's just a flood of central bank and government support coming into economies, and that'll help the market. I mean, we're spending, as much as we did as a percentage of GDP coming out of the Second World War today. So it's just an incredible amount of quantitative easing and money that's going into the system, coupled with 0% interest rates. So I think that's a good environment for the market, at least in the short term. And I think the risks around sort of unemployment, recession is largely known at this point in time. Now, I think the caveat to that is if we see a second wave of COVID-19, then I don't think that's priced in. So we will see weakness. And looking longer term, medium to longer term, is high levels of unemployment traditionally have not been good periods to the market. So my feeling is sort of things that over the next 6 to 12 months will be okay. I think the market will do well in that period and won't hit new lows. But I do see risks sort of going to 2021, 2022, that we see it grind down just because we were in recession, unemployment, is still very high, and a lot of these subsidies like JobKeeper and so forth will come off, and the reality will hit. So, hence why we're still playing the game in all the funds, but we're staying very liquid.
And what does the smaller companies landscape look like today? It's such a varied universe and doesn't get the same coverage that big caps and probably even globals get. What's your assessment of the lay of the land there right now?
It's been fascinating to see the small cap industrial market in terms of how it's performed through coronavirus. I mean, from WAM Capital, WAM Microcap, that's the vast majority of the stocks we invest in. These stocks are highly volatile. They offer investors greater return, but also higher risk. So generally when we see periods of dislocation or market falling, these stocks will fall harder than, say, like a large cap company like BHP or Commonwealth Bank. And that's exactly what happened through March. But what's been fascinating is through the rebound is these companies have actually performed much stronger than large cap companies, which we think, these companies have actually gone too hard, and we think that they're probably due for a sell-off. The reasoning behind that, I think, is because there's a high weighting of the technology sector within small cap industrials. And if you have a look at the United States, the technology sector has performed extremely well. They've had very good results through the March reporting season. So we think this is translated into Australia. Now, as I said before, I think valuations are run too hard, so we would expect large caps to do probably a little bit better over the next few months.
What are some of the permanent structural changes that you're observing, and particularly how do they relate to the universe that you're investing in and down to some of your positioning?
Yeah, I think the most obvious change around sort of the structural changes coming out of COVID-19, the first one you've got to look at is online, and in particular in retail. So companies such as Temple & Webster, Kogan have done very, very well over this period. But even some of the retailers we see we see value in, such as like a City Chic or an Adairs, which actually has quite a high proportion of their sales, over 40 to 50% of their sales are actually focused in online. So these companies are the ones that have actually lagged some of the pure play online retailers, and we think they look quite interesting over the coming months. If I look at other sectors, in the lottery space, Jumbo Interactive, which is a digital online reseller of lottery tickets, that looks interesting. Education, IDP Education is shifting their business online as well. But I think the big structural change that we see, and we've seen it through very strong results, is around those companies offering services to the cloud computing industry. I think those companies that haven't outsourced their IT infrastructure over this period have been impacted. And so I think we've continued to see growth, but I think this will continue to accelerate. And so beneficiaries are a lot of the data center companies such as NextDC, Megaport, the distributors such as Data3 or Dicker Data. So yeah, that would be a selection of sort of the sectors we see that have positive structural changes going forward.
You mentioned earlier, you talked about the strength that you've seen in the technology sector. I think the NASDAQ is starting to push into positive territory for the year, and you've talked about that part of the small and mid-cap universe having a good run here. It was a notable comment from your roadshow presentation at the end of last year. You felt like that was not an area that you wanted to participate in. It was expensive. You thought it was overvalued. Have you been forced to revisit that, or has the quality of those companies as they've performed during this period sort of drawn you back to that sector?
I think that the beautiful part of the sell-off in March was valuations got to levels in companies that we haven't been able to buy because they don't fit our investment process in that space. And so a number of companies such as, say, like a Appen, a Xero, we were actually able to add to the portfolio of this period. And I think the resilience of those companies have really surprised me through this period. I mean, you won't get a greater test than how recurring and sticky these companies and their clients will be through a period such as COVID-19. And if I look through some of the companies in that sector, say like a Technology One, an Objective Corp, an Infomedia, they've really held up well, and they're actually hitting their numbers that they said they would do before the crisis actually started. So I think, in this space, you've got to be selective. Not all, there's some pretenders in this space, and I think I've said this before. Not all companies are going to mirror Apple or Google or Facebook globally. You've got to be careful around that. But there are some true companies that deserve premium valuations because they are truly recurring businesses, and have sticky customers. And those are the ones that we've been focused on. And the benefit of the sell-off in March was that we could actually buy them, and they still sit in the portfolio today.
Talk us through your thesis on ag, and maybe before you get into the specific thesis, how do you think about investing in a sector that is so cyclical?
With ag, and we've owned Elders and GrainCorp for some time, and we made a call sort of this time around last year where we looked at consensus earnings numbers for both the companies, and we said, well, you know, is this pricing in a recovery back to an average season? And they weren't. So I think at the time, sort of, I'll give you an example, say Elders, they made a series of acquisitions, particularly the Air acquisition back in July. And if you assumed an average season, there was effectively like 15 to 20% upside in terms of earnings from that we saw for the forecast from analysts. So we held a small position in both the companies. And then I think as soon as the rain hit straight after the fires, we really increased our holdings in both of those companies. So if I look at Elders, fabulous management team, business was on the rocks just over 5 years ago, done a fantastic job. It's now reverted to growth, opportunity for them to consolidate the market, given the number one and number three players have effectively merged. So we quite like that one. It's still on a cheap valuation. GrainCorp, largest logistics provider for the grain industry on the eastern seaboard. Post the divestment of the malt business, the business has a much better balance sheet, and we think a lot of the efficiency savings that they've talked about will now come out in the next couple of years with a decent crop. So we like those two. It's a hard space to invest in because it's very dependent on the weather. But I think the common theme across the ag sector is that most of the company, or a vast majority of the companies, have very strong balance sheets. So that gives you that added protection if things get worse.
What about the next level up? I think about what's happened over the past few months, and I think Australian products, particularly in food, are going to continue to command a premium, and they're going to be well sought after. Examples that spring to mind are like your A2 milks and those sorts of things. Do you look at playing it at that next level up? I mean, there's things like Freedom Foods and Bega, A2, some of the formula producers. Have you thought about extending that idea to the next level up?
Oh, definitely. I mean, A2 milk's been one of our larger positions, or probably the largest position in the portfolio for at least in the last 6 months. I mean, fabulous company, management's done a fantastic job. I think you see the benefit of how they've marketed the product in China through this period and how popular the product is, and it's effectively an essential product. To answer your question, definitely, I think products and food security and so forth, particularly through this the COVID-19 pandemic, is incredibly important. It's definitely a theme where we're playing in through the portfolio.
Are there some companies that have really surprised you? There's some zeros and that sort of stuff. You think, they're pretty high qualities. But there are a couple of lesser known companies that have really surprised you with how resilient they've been. Oh, yeah,
definitely. It's funny going through this crisis, and we go through the various iterations. I remember early on we're like, KFC restaurants, that'll be fine. So we'll buy more Collins Foods, and then 3 days later it was like all restaurants are closed in Europe, and you saw the share price fall. But I think one stock I am incredibly surprised at how how resilient it's been has been Appen in the technology sector. High proportion of their customers, and these guys are focused on artificial intelligence and machine learning. They're highly dependent on effectively the large tech companies to deploy research and development budgets to them. You would think in a crisis such as this that they would pull back their budgets, but they haven't. They've kept spending through this period, and it shows you the demand for artificial intelligence. So that would be one stock prior to COVID-19 I would thought would be in a bit of trouble, but it seems like it's companies confirmed guidance, got the AGM coming up. I think they'll probably be fine. So there's certainly one stock that has been incredibly resilient, and A2 Milk is another one. And again, that just shows the strength of the brand through this period. And I'd also say sort of the data center providers like a NextDC and Megaport, and just that strong demand to outsource, I guess, your infrastructure within the workplace. It's just continuing, and they're not seeing pricing pressure or anything like that. So I would say they're the sort of 3 or 4 stocks that I've been very surprised in terms of their resilience.
You're not going to get a chance to meet face-to-face with investors on the roadshows. Got a quick message for some of your shareholders?
Oh, look, I mean, it's been incredibly tough time for the team. You know, I had a joke the other day with Matt and Johnny and the large cap teams, like Sundays are the new Mondays, because we just get calls at ridiculous times on the weekend from investment bankers on deals and so forth. But like we're functioning really well. Like it was really hard in the first few weeks. I won't deny that. It was hard communicating. It was hard to know what the market was doing. You know, stocks were moving all around the place. But I think, you know, we've come through this period that, you know, the wider teams communicated very well. From a WAM Capital perspective, we've done very well. So I think, yeah, look, it's going to be in for a wild ride. There's no doubt about it. It will move around a lot. But, you know, in terms of how the team's performing, you know, we couldn't be happier. And I'd say, you know, just, you know, appreciate all the support from all the investors. You know, it's getting all the feedback from the conference calls and the Q&A, and even for this, you know, in terms of, you know, the positive feedback is just, you know, fantastic, and really appreciate all the support from over 80,000 of you, basically. So appreciate it.